Hey everyone, Asian guy back with you. I need you to shut everything down right now. Whatever you're doing, whatever tabs you have open, close them. Because what I'm about to break down for you will fundamentally shift your perspective on what's actually going down in the silver market at this very moment. This isn't me throwing around theories or wild speculation. What I'm showing you today is concrete action taken by one of the world's biggest economies. Action that reveals a crisis so deep, so concerning, that regulators were forced into panic mode with emergency interventions. And if you miss what this intervention really signals, you're going to completely misread the most crucial message precious metals have sent us in more than 10 years. Look at where we are right now. Silver's sitting at 85.15 an ounce, gold's at 4,118s. And here's what you need to get before we dive deeper. These numbers aren't some kind of peak. They're nowhere near what fair value actually looks like. What you're seeing is a war zone where control is being battled over in real time. While everyone was glued to their screens, watching charts, checking portfolios, something absolutely massive just went down. The Chinese government, no warning whatsoever, no apologies, just slammed the door shut on 5 different commodity funds in one single trading session. We're not talking about a brief pause here, not some cooling off timeout, complete shutdown, total trading suspension. The only silver futures fund that mainland Chinese investors could access, locked down for an entire day, 4 oil-focused funds, frozen solid until further notice, all at the exact same time. This wasn't scheduled maintenance. This wasn't some technical glitch. This was pure emergency response to what regulators themselves called systemic risk and massive investor losses that were about to hit. But here's the kicker, and this is what separates this moment from every other time we've seen regulatory intervention. This marks the second emergency shutdown in just 8 days. Whatever they thought they'd fixed on January 22nd clearly fell apart. The problem came roaring back with such intensity that they had zero choice but to hit the emergency brake again. When the planet's second largest economy starts throwing up emergency trading halts because commodity demand has spiraled completely out of their control, you can't just brush it off as typical regulatory nonsense. You can't wave it away as China being China, because what's happening in their markets directly reflects pressure that's building absolutely everywhere. And that pressure is about to explode through new channels. I'm here to show you exactly where those channels are, and more critically, how you position yourself before the next explosion hits. Before I tear this apart for you, I need something from you. If what I'm laying out here is giving you the kind of clarity nobody else is delivering, smash that like button right now. It pushes this message to people who desperately need to see it. And if you haven't subscribed yet, do it now, because what's rolling out in February is going to separate those who saw it coming from those who got blindsided. Let me walk you through exactly what went down, because every single detail tells us everything we need to know. January 30th, Chinese financial authorities executed what can only be called coordinated emergency suspensions across multiple commodity investment vehicles. The biggest target? The UBS SDIC Silver Futures Fund. This isn't some random regional product we're talking about. This is the one and only public fund in all of mainland China that directly invests in silver futures. The only one. Think about that for a second. 1.4 billion people have exactly one regulated option for silver futures exposure. And that single option gets completely shut down for an entire trading day. You're not watching routine market management here. You're watching panic containment in action. But it gets even crazier. At that exact same moment, 4 separate oil-focused, listed open-ended funds got hit with synchronized suspensions, every single one frozen until 10:30 a.m. Beijing time. The coordination here is the smoking gun. When regulators move on multiple funds simultaneously across different commodities, they're not dealing with isolated issues. They're responding to complete systemic breakdown. So what actually broke? What forced their hand like this? The answer comes down to premiums. Specifically, the insane gap between what investors were paying for fund shares versus what the underlying assets were actually worth. And the numbers are absolutely mind-blowing. The UBS SDIC Silver Futures Fund was trading at a 36% premium to net asset value. Let me repeat that so the magnitude really hits you. Investors were paying 36% more than what the actual silver futures were worth just to get exposure through this fund. Picture what that means in real terms. If you bought shares at that premium and the underlying silver futures didn't move at all, you'd be sitting on an immediate 36% loss the second that premium normalized. You weren't buying silver. You were buying pure desperation. You were buying fear of missing out at literally any price. Chinese retail investors had gotten so desperate for silver exposure that they were willing to pay more than a third extra just to get through the door. They weren't asking what the metal was actually worth. They were asking how fast they could get positioned before it ran away from them completely. And regulators saw exactly where this behavior was headed. They saw retail money pouring in at prices that made zero mathematical sense. They saw the feedback loop building momentum. The higher that premium climbed, the more momentum chasers saw it as confirmation that silver was the hottest trade on the planet, so they piled in harder, pushing the premium even higher, which attracted more momentum chasers. This is the death spiral that regulators decided to stop before it consumed their entire retail investor base. Not because they hate precious metals, not because they want to crush prices, but because they understood that when that premium inevitably collapsed, the losses would be absolutely catastrophic for millions of people who had no clue what they were actually buying. Now here's the question that nobody in financial media is even asking. Why was demand so extreme in the first place? Why were Chinese investors willing to pay 36% premiums when they could have just waited? The answer reveals everything about exactly where we are in this cycle. Silver has been on an absolute rampage. Just in the last 30 days, silver has exploded 58%. Not 5%, not 15%, 58%. We're looking at prices that push toward $118.58 per ounce at the peak. Numbers that would have seemed completely delusional just 6 months ago. Gold's been running equally hot, up 22% and approaching $5,600 per ounce. Oil has smashed through resistance with Brent crude hitting 5-month highs above $70 per barrel. This isn't random price action, this isn't sector rotation, this is coordinated flight into hard assets driven by forces that are accelerating, not slowing down. First, you've got monetary policy chaos. Central banks have been whipsawing between aggressive cut expectations and higher for longer rhetoric. Every time traders price in easier money, the dollar weakens, real yields compress, and precious metals catch fire. Every time hawkish comments return, we get violent sell-offs. This back and forth has created extreme volatility, and that volatility gets amplified through leveraged instruments like the funds China just suspended. Second, there's the geopolitical overlay. U.S. naval positioning near Iranian waters, escalating tensions across multiple theaters, energy supply chains looking vulnerable. When traders start pricing conflict risk into oil, when investors start hedging currency debasement through precious metals, you get the kind of demand surge that completely overwhelms normal market infrastructure. Third, there's the structural supply crisis that almost nobody is connecting to current prices. Silver isn't just a monetary metal, it's an industrial powerhouse. Solar panels devour silver. Electric vehicles consume silver. 5G infrastructure eats silver. The green energy transition that every major government has committed to is fundamentally silver intensive, and supply has not kept pace with this structural demand growth. When you combine monetary demand, safe haven demand, and industrial demand all hitting simultaneously, you don't get orderly price discovery. You get the kind of violent moves we've been witnessing. And when that demand gets funneled through a single investment vehicle serving 1.4 billion people, you get 36% premiums and emergency trading halts. Now I want to show you something that proves this isn't isolated to China. Because what happened in Beijing is a symptom of pressure building everywhere. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has compressed to its lowest level since 2011. That compression isn't happening because gold is falling. It's happening because silver is playing catch-up in a dramatic way that historically signals major regime change. At the same time, physical silver demand has been exploding globally. One major dealer reported a 158% increase in sales of 1OZ silver coins in less than 4 months, a 550% increase in demand for 1 kilogram silver bars over the same period. Google searches for how to buy silver and buy silver online have spiked 250% in recent months. This isn't niche interest. This is mass awakening. People are looking for ways to get precious metals exposure outside the traditional financial system, and physical accumulation is one of the clearest expressions of that impulse. So when Chinese regulators shut down their only silver futures fund, that demand doesn't just vanish, it redirects. Some flows into physical silver, some flows into Hong Kong listed products, some flows into gold as an alternative, and some creates pressure on international markets as capital finds other pathways. This is the critical point everyone's missing. The trading halt didn't kill demand, it just forced that demand to find new routes, and every new route it finds creates additional pressure on global supply chains that are already stretched to the breaking point. Let me show you the smoking gun that proves this entire thesis. Usually when a market crashes or gets halted, it triggers a feeding frenzy on the short side. Hedge funds smell blood. Algorithms pile in. They borrow shares and try to ride the price down. When that happens, the cost to borrow shares skyrockets because everyone's fighting for the same inventory. But right now, the borrow fee for SLV, the largest silver ETF in the world, is sitting at basically zero. Rock bottom. And there are millions of shares available to borrow just sitting there, collecting dust. Nobody wants them. Nobody's shorting. Do you understand how insane that is? China just implemented emergency trading halts. The narrative should be that the silver rally is over, that regulators are clamping down, that the trade is crowded and vulnerable, and yet the smart money is refusing to bet against it. Why? Because hedge fund managers aren't stupid. They're looking at the same data we just looked at. They see the 58% move in 30 days. They see the physical demand explosion. They see the structural supply deficit. They see Chinese demand getting redirected into other markets. And they know that shorting silver right now is like standing in front of a freight train holding up a piece of paper that says, "Stop." The freight train is global demand for hard assets. And if you stand in front of it, you don't get rich. You get obliterated. This tells us exactly who's responsible for any price weakness we're seeing. It's not the market. It's not institutional selling. It's a small handful of bullion banks dumping contracts to keep the price contained. They're naked shorting positions they don't have because they're desperate to cap the price and protect dollar credibility. But they're alone. The rest of the financial world is standing on the sidelines, refusing to join them, because the smart money knows this $85 price isn't a ceiling. It's a coiled spring. And the moment the suppression stops, the arbitrage will wake up and the price will gap violently higher. Now, I need to talk about the oil side of this story because it's connected to silver in ways most people are completely missing. Remember, China didn't just suspend the Silver Futures Fund, they hit 4 separate oil-focused funds at exactly the same time. That coordination is the tell. When regulators move simultaneously across different commodity sectors, they're seeing the same pattern playing out everywhere. And here's what that pattern looks like. Brent crude broke above $70 per barrel for the first time in 5 months on the exact day these suspensions happened. That breakout coincided with U.S. naval vessels positioning near Iranian waters. The market was pricing geopolitical risk premium directly into energy prices, and Chinese investors were chasing that trade through oil-focused funds with the exact same momentum behavior they showed in silver. Let me show you the feedback loop that regulators were trying to break. When geopolitical tensions rise, commodity prices rise. When commodity prices rise, retail investors chase. When retail investors chase through concentrated fund structures, premiums expand. When premiums expand beyond sustainable levels, regulators intervene. But here's the critical part everyone's missing. The intervention treats the symptom, not the cause. The geopolitical tensions are still there. The supply vulnerabilities are still there. The demand is still there. Suspending trading for an hour doesn't make those forces disappear. It just compresses them temporarily. This is why I believe the oil story is far from over. And more importantly, it's why the oil story validates everything we're seeing in precious metals. Because they're both being driven by the same underlying force, loss of confidence in paper systems and flight into physical assets. Think about what oil and silver have in common. They're both strategic commodities. They're both essential to modern infrastructure. They're both vulnerable to supply disruptions. And they're both traded in markets where paper contracts massively outnumber physical delivery capacity. When those markets come under stress, when demand surges faster than supply can respond, when geopolitical risk makes future availability uncertain, investors start questioning whether their paper exposure will actually convert to physical delivery when it matters. That's when premiums explode. That's when funds start trading at 36% above net asset value. That's when regulators panic and shut everything down. But shutting down trading doesn't create more oil. It doesn't create more silver. It just hides the supply crisis temporarily behind regulatory curtains. And here's what happens next. The pressure builds. The demand finds alternative routes. The premiums show up in different markets: Hong Kong, Singapore, London, wherever Chinese capital can flow without restriction. This is already happening. We're seeing it in the physical silver premium data. We're seeing it in the compressed gold-silver ratio. We're seeing it in the refusal of institutional money to short despite apparent vulnerability. The smart money understands what regulators don't want to admit. You can suspend trading, you can implement cooling off periods, you can restrict new fund purchases, but you cannot suspend the fundamental forces driving demand. And you cannot manufacture physical supply with regulatory decree. So when I look at China's intervention, I don't see the end of the commodity rally. I see confirmation that the rally has gotten strong enough to threaten systemic stability, and that tells me we're nowhere near the top. Because if we were near the top, regulators wouldn't need to intervene. Weak hands would be selling naturally. Premiums would be compressing on their own. The market would be finding equilibrium without emergency measures. The fact that they had to shut down trading twice in 8 days tells you the opposite. It tells you that demand is so relentless, so overwhelming, that normal market mechanisms can't handle it. And when normal mechanisms can't handle demand, that demand doesn't disappear. It just gets more creative about finding outlets. Now let me address the elephant in the room, because I know some of you are thinking it. Yes, silver has momentum. Yes, the fundamentals look supportive. Yes, China's trading halt reveals genuine demand pressure. But markets that run this hard this fast are also prone to sharp corrections. The same volatility that creates 58% gains in a month can create 30% drawdowns in a week. Some analysts have projected silver reaching $150 within 3 months. That's a bold call, and it might be right. But it's also the kind of projection that tends to appear near cycle tops rather than bottoms. When major institutions start publishing aggressive upside targets, it's often a sign that retail enthusiasm is peaking. I'm not saying sell everything. I'm not saying the rally is over. I'm saying be aware of where we are. The easy money has been made. The obvious trade has been executed. What comes next requires more nuance, more patience, and more discipline. If you're already positioned in silver, this is probably a time to think about risk management rather than adding at extended prices. If you're not yet positioned, this is probably a time to wait for pullbacks rather than chasing momentum at 52-week highs. The people who build real wealth in these markets are the ones who buy fear and sell greed. Right now, there's a lot of greed in the silver market. That doesn't mean the bull run is over. It means the next phase will require more skill than the first phase. But here's what I want you to understand about China's intervention. This is not the end of the story. This is the beginning of a pattern. When commodity markets get hot enough to threaten systemic stability, regulators will intervene, they'll suspend trading, they'll restrict new purchases, they'll implement cooling off periods, they'll do whatever they think is necessary to prevent retail investors from destroying themselves. That doesn't mean the underlying trend is wrong. It means the trend is strong enough to scare authorities. And when trends get that strong, they tend to have more room to run once the intervention pressure eases. The historical precedent is clear. Every major precious metals bull market has featured regulatory interventions along the way. The 1970s bull run in gold had multiple moments where authorities tried to cool the market. The 2000s run featured similar dynamics. Each time, the interventions created temporary pauses, but didn't reverse the fundamental forces driving prices higher. I'm not saying history will repeat exactly. I'm saying the pattern of intervention during strong bull markets is normal, not exceptional. If you're using China's trading halt as a reason to panic out of positions, you might be misreading the signal entirely. Let me give you a framework for thinking about what comes next, because frameworks are more useful than predictions. First, recognize that China's trading halt is a signal, not an endpoint. It tells you that demand for commodity exposure has exceeded the infrastructure's capacity to handle it smoothly. That kind of demand doesn't disappear when you suspend trading. It redirects, it builds pressure, and eventually that pressure gets released. Second, understand that premiums and discounts in fund structures are information. When a fund trades at a 36% premium, the market is screaming something about desperation levels and supply constraints. That information is valuable even if you never trade that specific fund. Third, differentiate between trading and accumulating. If you're trading short term, this is an environment that rewards patience and punishes chasing. Wait for pullbacks. Don't pay premium prices for exposure. You can get it cheaper next week. If you're accumulating long-term, short-term volatility matters less. You're buying the decade-long thesis about currency debasement, industrial demand, and hard asset repricing. In that framework, temporary suspensions in Chinese funds are noise, not signal. Fourth, pay attention to the physical market. When fund trading gets disrupted, physical metal becomes more attractive. The premiums dealers charge for physical silver and gold are information. When those premiums expand, it tells you the physical market is tightening. When they compress, it tells you supply is catching up with demand. And right now, the physical market is screaming. Let me show you the data nobody's connecting. Major dealers are reporting unprecedented demand patterns. 158% increase in 1OZ silver coin sales in less than 4 months. 550% surge in 1 kilogram bar purchases over the same period. These aren't marginal increases. These are panic buying levels. But here's what makes this data even more significant. This physical demand explosion is happening simultaneously with China's fund suspensions. Think about what that means. Chinese investors can't get futures exposure through their preferred fund. So where is that capital going? Part of it is flowing into physical metal. Part of it is finding alternative paper vehicles, but the physical component is real and measurable. When you shut down paper access in the world's second largest economy, you don't kill demand. You redirect it into channels that are even harder to suppress. Physical metal doesn't have trading halts. Physical metal doesn't have fund managers who can block purchases. Physical metal is the ultimate escape hatch from financial system control. This is why I keep emphasizing the importance of watching dealer premiums. When premiums on physical metal start expanding significantly above spot prices, it's telling you that the paper price is disconnected from physical reality. It's telling you that people are willing to pay more than the official quote, just to secure actual possession. And we're starting to see those premiums tick up in certain markets. Not everywhere yet, not uniform across all products, but the trend is forming. And if Chinese demand continues redirecting into physical channels, those premiums will expand further. This creates a self-reinforcing dynamic that regulators cannot stop. The more they restrict paper trading, the more demand flows into physical. The more demand flows into physical, the tighter the physical supply becomes. The tighter physical supply becomes, the wider premiums expand. And wider premiums validate the thesis that paper prices are artificial, and physical possession is what matters. You cannot regulate your way out of a supply crisis. You cannot suspend your way out of fundamental demand, and you cannot wish away the consequences of decades of underinvestment in mining capacity while industrial consumption accelerates. China's intervention is trying to manage symptoms while ignoring causes, and that approach has never worked in commodity markets, not in oil, not in copper, not in agricultural products, and it won't work in silver. Fifth, watch the gold-silver ratio closely. This metric has been one of the most reliable signals in the precious metals complex for decades. When it reaches extremes and starts to mean revert, the moves can be powerful. We're in one of those reversion phases right now. Whether it continues or reverses will tell you a lot about where we are in the cycle. Now let me talk about what I think is actually happening beneath all of this volatility. What we're watching right now is a stress test of global commodity market infrastructure. The combination of geopolitical uncertainty, monetary policy confusion, and structural demand growth is pushing markets in ways they weren't designed to handle. China's response of suspending trading is one approach. Other jurisdictions may respond differently, but the underlying pressure is the same everywhere, and that pressure tends to produce something very specific over time. It produces repricing. It produces revaluation. It produces a fundamental shift in how people think about what's valuable and what's risky. Paper assets that seemed safe start to feel fragile. Hard assets that seemed old-fashioned start to feel essential. Fiat currencies that seemed stable start to feel experimental. Physical commodities that seemed boring start to feel strategic. That's not a prediction about next week or next month. That's an observation about where we are in a multi-decade cycle. The people who recognize these cycle shifts early are the ones who position themselves for generational wealth transfer. The people who dismiss them as noise are the ones who get left behind holding devalued paper. Here's my question for you, and I want to see this discussion in the comments. Do you think China's trading halt is a warning sign that the silver rally has gone too far? Or do you think it's confirmation that demand is so strong that even regulators can't contain it? There's no wrong answer, but your answer reveals how you're interpreting this moment, and that interpretation will shape your positioning going forward. Drop your thoughts below, and if you've been navigating this precious metals rally successfully, share what's worked for you. Real-world feedback from this community is valuable for everyone watching. Let me leave you with one final thought that captures where we are. When authorities intervene in markets, they're telling you something important. They're telling you that the market has gotten strong enough to scare them. And when markets scare authorities, it's usually because something fundamental has shifted. The structural forces driving precious metals demand are not going away. Currency debasement concerns are not going away. Geopolitical uncertainty is not going away. Industrial demand for silver and green technologies is not going away. Central bank accumulation of gold is not going away. These are multi-year themes, not multi-week trades. And if you're positioned for the multi-year story, the day-to-day noise of regulatory interventions and volatility spikes becomes much easier to navigate. Let me give you one more framework for thinking about this moment because I think it captures something essential that's easy to miss in all the chaos. Markets move in cycles. Bull markets, bear markets, consolidation phases, breakout phases. And within those larger cycles, there are smaller patterns. Regulatory intervention is one of those patterns. And it tends to happen at specific points in the cycle.